This year is about ammunition and the speed of that delivery. Just amazing when you find out these things, Tom. We kind of know these things happen. When you find out these things to this degree, Anne-Marie, you realise just how effective some intelligence community actually is. Detail for the United States on individual countries, just remarkable. Yeah, and to be clear, I think the whole media, I know in surveillance we feel this strongly. We're not going to speculate and guesstimate what that level. You mentioned balloons. You said at the time, Tom, I remember talking about it. Who was the outrage for? Was it for China or for public consumption? And to some degree, it felt like it was for public consumption because the administration was aware it was happening. And remember, Secretary of State Antony Blinken was scheduled to go. Had a trip planned even though he knew this kind of thing was happening. The issue, of course, with the spy balloon was that it became also the catch up. Alleged. We should say alleged. As always, you can throw out it. Of course, it's alleged because it's from this money. It's for weather, right? Okay. The alleged weather. Is this where they film balance of power? It is. You say, oh. See, is there? Appreciate that. Okay, from Washington through the week in John Emery seats. Equity futures unchanged. This is really very, very weak. 家から一歩踏み出すと庭にもう一つの部屋がラグジュアリーな空間自然と調和したデザイン Is it too early for the countdown clock for the inflation data on beams and that's really fun? That's why TK loves this stuff. 25 minutes to go. That's about 3 hours away. 3 hours away maybe. From Washington DC this morning, good morning to you. Here's the price action at the moment on the equity market. Futures slightly positive for most of this morning on the S&P. Certainly just a little bit negative on the Nasdaq. We're down about 0.2% to 4%. The S&P 500 totally unchanged. We talked about the data this week. CPI tomorrow. We get Federal Reserve minutes as well. Later on in the week, some bank earnings in the mix as well. Michael Hyatt from Bank of America. Investors are too optimistic on rate cuts, not pessimistic enough on recession. Capturing some of the recessions or the movement of the bond market over the last month or so. Just an aggressive bull steepener, which basically means we're a big rally at the front end of the curve. We've gone from 5% to south of 4. Had a look at 360-ish last week, Tom. Right now, 398. So I'll stop the show and partition the brilliance you just said, which is it an interest rate and monetary analysis, or is it just the blunt instrument of economic slowdown? That's what Mr. Hart is talking about. Just forget the Fed mumbo jumbo, just on a GDP basis, we're not going to be there, which channels what we're hearing from the IMF. I'll keep returning to the conclusion, the consensus view after the banking stress of the last month. The view was that would turn into this inflationary bust, and that was captured in the bond market pretty quickly. The 2 year goes from 0.5 to south of 4, has a look at 360 last week off the back of a week of weak data, Tom, so to speak, in the US economy. And then payrolls gives you a lift again on the front end of the curve, a bit of an upside surprise. So Tom, ultimately, that's the call at the moment. We can take a different view if we want. The Federal Reserve certainly taking a different view on things. They can get rates to north of 5% and hold them for the rest of this year. I think we're setting up here, folks, with a different view, and I got to go to the inflation report. I want to make clear we are in Washington, but we will continue with our global economic, finance, and investment coverage here around international relations. Someone who does that each and every day in the Beltway with Rock Creek Group is Alethea Darwala, Managing Director at Rock Creek, really managing money, listening to institutions, and where to place the next marginal capital. You dovetail, it's actually like your beloved Georgetown, you dovetail economics right into finance and investment as well. Are you petrified about an IMF call of OMG, global recession? I think, the IMF came out in October, but we've also seen some contrary opinions out there, right? And then you look at the equity markets, you look at the disconnect between equity markets and bond markets, both telling you extremely different things, and I think it's a little puzzling out there. I do think, unfortunately, there's more downside in the equity markets, and there is upside today, whether or not the IMF is right on their 5-year, 7-year calls in terms of global GDP. So where are you in the equity market? Are we in all cash, or are we in the triple leverage all cash fund, or did you participate in the equity markets given your caution? Well, last year cash was one of the best trades out there, right? Or the 6 months T that wasn't bad for the CP was probably the best trade of a lot of institutional investor portfolios. We are defensive and pretty cautious in equities. That being said, you have a long-term portfolio, you can't be out of the equity markets. And you would have missed, what, an 8% rally, 20% rally in the Nasdaq? Yes, I did. So the market, bond market is basically the same rate cuts, and the equity market, to some extent, is conveying this idea that rate cuts are good. Because the Nasdaq will do well, growth will outperform, tech will deliver, and that's what we've seen yesterday. Are you on board with that on the tech side of things? I think the tech, could have been a little bit of a dead cat bounce. I think we saw a lot of investors overselling probably last year. Those that are longer term, that want to be in these tech stocks longer term. If you look at active management, you have bias towards growth, right? And so most of these big money managers are going to have to be in some of those large growth stocks. And if you look at the very big tech, let's say the top 5, cash on the balance sheet, lots of layoffs, lots of massive cuts, you could argue that they're not in a terrible position for the rest of the year. The question is what about the rest of the tech sector, and then let alone the private sector in tech. So let's get a little bit more specific. So I can look at retail, efficiency. The stock has done tremendously well year to date. Tesla, another name. It's a difficult tease over the last week or so, but year to date, I think still up about 40% or so. Within tech, which is just a massive monster universe, what do you think is vulnerable? Yeah, I think definitely you have the larger tech, which is not as vulnerable as those smaller companies that are going to really be, very much prone to consumer demand and an economic recession. And so if you get an economic recession, you're going to see the majority of smaller tech companies really struggle to survive. The soul and the heritage of Rock Creek Group is what I'm going to call the global hydrocarbon template overall. Fold in, OPEC Plus was a surprise, I think 10 days ago as well. Fold in how hydrocarbons affects your equity belief. Well, I think not necessarily specifically on the equity side, but it affects our portfolio longer term in terms of how we're positioned, right? We definitely are positioned longer term to benefit from climate adaptation, climate transition. transition, renewable energy, all of those things, mostly on the private side, but also a little bit on the public side. We saw that some of the renewable energy companies had their best years ever last year, a little bit more trouble more recently, but I think longer term, that is where you want to be. If you just look at the future in terms of a 5-10 year time horizon, that is where companies are going. The business model is going to have to change.
Unfair question, but we don't make some news this morning. Does big oil have a future?
I think big oil will always have a future, but it depends on what you define as big oil. That might change.
What would you define as big oil? Why is that will change? Talk to me about that.
Well, I think in 5-10 years, big oil might have a large percentage coming from hydrocarbon, from renewable energy sources. I think it'll have to have alternative energy sources to diversify its business.
Last year, we saw a bit of a spread emerge between the US players, massive outperformance in the equity market, big integrated oil majors, versus the European players. Now, the European players still had a decent year, but relative to some of the US names, underperformed. Do you think that's because the US names were a pure play on fossil fuels relative to the European names, which have gone elsewhere?
I think there's also some macro headwinds, right? I mean, you look at all of the tensions in terms of Europe, the effects from the Russia-Ukraine war on energy, winter, all of those. I think that is probably a little bit more of a macro headwind, potentially for some of those big European oil plays versus the US, which are a little bit more isolated.
I'm just wondering, the reason I ask that question is from your perspective, which of the oil majors are better positioned for the transition you're expecting? Where do you think some of these names need to be in the future?
Yeah, I think some of the European plays go far ahead in terms of that area. I mean, I think it's undeniable if you look at what Europe has done and all of the investment that they've made, that, some of the US players are probably behind and are starting to try and really catch up because they know where the future's heading.
How do you process the tension and the bipartisan tension of the United States of America with China right now? Is there a strategy for investment given this new friction?
It's a topic that comes up with all institutional investors. China has been a major part of asset allocation, thinking about it in China over the last 10 years. I think that's really shifted, and I think there's a lot more negative or caution on China. And does it need to be as big of a play in your emerging market portfolio, or are there places like India over the next 5 years that will take that role?
Big change, Tom.
We can go like another 30 minutes there on China to India. Tim Cook, good morning, Mr. Cook. Want to expand on that for Apple, please?
Well, I think Apple already knows where the future might be heading.
Thank you.
They're very sensitive about what they do.
Big time.
Big spike. Like Tim Cook, the Putin administration was just never the same one with the Trump administration. Just never the same one with the administration. Still,
I think it goes back to the wonderful Mr. Jobs. And frankly, I'm not going to miss words here. Part of it was because this was a Syrian immigrant who founded this incredibly successful once-in-a-lifetime company. And the answer is they've always had a distance and reticent from the news from.
Mark Gurman at Bloomberg, of course, read that fantastic story last week or so about how China, how Apple is trying to pull back from China, but doing it in a diplomatic way so they don't trigger anger in China. What do you make of Apple's ability to do these things in a way that other companies seem to struggle to?
Well, I think there's have to redefine pullback, right? I mean, that's going to be a slight pullback. No one's leaving China. It's too big of a market there that they can't, right? If you're Apple, you have to be there. But I do think their incremental investments are going to be all over.
Is India an analog to China, or is it its own beast?
I think it's its own beast if it can get out of its own way. I think they also obviously have a lot of people.
This is great, as always. We've got a run of Rock Creek groups on tech, on energy, the equity market, on all of the above.
Well, this is what Rock Creek invented. I mean, Special Auction and the whole crew, they just wrapped it around a geopolitical discussion. That's what people listen to. That's why you've got to synthesize. I mean, take Lisa's kids. They're on the couch doing a rather than mean thing. You've got to synthesize World Bank and IMF analysis into what do you do with AMC and GameStop.
The big development, Tom, I think, in the last week still is the words of Macron on China. And the data that he's put between the United States and Europe. Now, whether you think that's just a lone view of a man trying to make some news on the international stage because he's got problems at home, I think that's maybe the cynical take. I wouldn't go that far. I think he truly meant what he said about the relationship with China that he'd like to see that Europe might have.
And I've been listening to yourself. You've been great about bringing that up. I 100% agree. There's a freshness here to what he's saying that harkens back to the ball ages ago. You're not going to fire Jets over 100.
The criticism that he's received, though, after the last weekend, I think is really
particularly on Taiwan.
This is exactly the kind of thing that the Europeans used to say about Russia. And they've ended up with a bunch of stranded assets and a misplaced energy trade. The leadership after leadership across the European Union has built up. Now, Angela Merkel, Germany was warned about this repeatedly for more than a decade. And what we experienced over the last 5 months because of that. And I think where those words might come back to haunt the French leader is on the very topic of Europe itself. Because at the same time, you can't say we won't just follow the US into a crisis that does not belong to us, when you are also expecting the US to follow you.
三ダイヤ、家族には安心できるものを飲んでほしいから。我が家
In Europe, the crisis that many people in this country, Tom, are arguing does not belong to the United States. It belongs firmly in Europe's backyard.
The other thing I would say is he's fighting for his political life. My amateur take is on the domestic front is more of a challenge. That's not just about having 2 years to retirement. That was so long ago, John. I cannot imagine that. Thank you for bringing that. Leaf is looking at us like, are they all time?
I think a lot of my generation, but we never hope he's going to retire. Thank you. Even this coming up, the co-founder and CEO of International, we'll talk a little bit more about China and focus on the economy as well. Just a sneak peek of the market for you. Equity futures turning lower in the last 30 minutes or so. I'd say the last hour. Equity futures down about 10.1% on the S&P. Yield just about unchanged on a 10-year, 3.41 on a 10-year yield in the FX market. Euro stronger, dollar weaker, euro dollar 1909, positive 0.5%. For Washington, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will head to Ireland today for a long-awaited return to his ancestral home. His first stop is Belfast, Northern Ireland, where he'll meet with UK Prime Minister Rishi Sunak. He'll then
then travel to the Republic of Ireland to mark the 25th anniversary of the Good Friday Agreement and celebrate the recent Brexit deal. Senate Democrats want an investigation into undisclosed luxury trips that Supreme Court Justice Clarence Thomas accepted from a wealthy Republican. They've asked Chief Justice John Roberts to conduct a probe. Senate Judiciary Committee, controlled by Democrats, will soon hold a hearing on the court's ethical standards. In China, the government plans to require a security review of ChatGPT-like bots. Providers of the generative artificial intelligence services must ensure content is accurate and neither discriminates nor endangers security. That casts uncertainty over AI bots unveiled by China's largest tech companies. A setback for Moderna. The biotech company says a final stage study of its first experimental flu shot hasn't accumulated enough data to determine how well it works. So now Moderna will start a study of an updated version. A flu shot is crucial to the company's future. Its COVID vaccine sales are expected to drop off. And Apple CEO Tim Cook heads to India next week, where he will open the company's first stores there. That underscores Apple's ambitions for the country as a growth market and a manufacturing base. Sales of iPhones in India have reached an all-time high. Meanwhile, annual exports of iPhones assembled in India have reached billions of dollars. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg. We still have that terminal rate at 5.5 to 5.75, so that's a 25 basis point hike in May, another in June, another in July. But again, it comes down to this timing issue. We need people to stop spending. You need credit to contract, and that's what slows the economy and brings down inflation.
It's a feature, not a bug. Chronic bug. Economists over at Citigroup looking for rates to get close to 6% over the Federal Reserve, 550 to 575, still the call. From Andrew Holmholtz and the team over at Citi. Welcome to the program. It's the equity market for you. Just a brief snapshot of things in the equity market at the moment. Futures turning lower. In the last 40 minutes or so, we're down not even 10.1%, but down about 0.04%. Elsewhere, into the bond market, we go with the 10-year basically unchanged. Your 10-year yield 341-ish, 340.93 on a 2-year at the moment. A 2-year yield comes here a single basis point, just short of 4%, 399.74. Getting close to that 4 handle this morning. Back in the way. Move lower we've seen in yields a little bit earlier on this morning. Just want to finish up with the FX market with the euro just north of 1.09 against the US dollar. Euro dollar 1.0907 on positive 0.4%. The next stop, we repeated it this morning, over and over again repeatedly. CPI come back tomorrow, Fed minutes as well, and then on to the bank earnings.
Let's put there on CPI tomorrow with some important headline. It's been there before. It's not a new idea, but maybe it's a more predominant idea. You may get a good headline. The core, even the people away from Citigroup are saying you may get a Citigroup core.
And that should keep the Fed in the game on May 3rd. Just a few. Given how quickly things have changed over the last month or so, this is not 2 weeks away.
Exactly.
Things should change this fast.
3 more points. This is a treat. If you're at the International Monetary Fund, you can lean forward and listen to Leland Miller, your co-founder, chief executive officer of China-based group, out of the Washington and Lee UVA Combine. Leland Miller joins us from China. I'm just going to cut to the chase. You're right about consumption. And they're not 70% of GDP. What's consumption in China? It's a lot less, right?
It's a much smaller share than these highs that they like to print today. Consumption is structurally weak in China because they don't incentivize consumption. The state represses households, it represses private firms, and so consumption has a very hard time ever getting a pickup. They ramp down investment. Incentivized consumption has been a very difficult.
How do you respond to World Bank and particularly IMF 5-year global GDP is shockingly stuck by 3% or less? And they'll say, yeah, India and China have 1-2, everything else is weak. And your model is out of China that's less than 1, right?
I think so, yeah. In 2023, we're going to get into better economic numbers in the coming months, no question. But it's going to get head fake because the most dominant model for China going forward is one significant structural slowdown. And this is something which the party giving up on high levels of growth. It's not focused on prioritizing growth at all costs. It wants to strengthen the core. It wants to tamper down the debt level. So at this point right now, the entire focus is how do you get China to the next economic market into something more sustainable. This is much slower growth.
What kind of levels of growth can we take through 3?
Maybe to start with, 2, possibly down to 1. A lot of this will be shown in China. This will be a reflection over time, over the coming years, a reflection of what local conditions are, et cetera. But there are numbers that they can announce. There's numbers they can't announce. If they fall off a cliff and they don't have something like COVID as an excuse, then everybody will panic. So they can't announce certain numbers, but the amount of growth they can do now that they've diminished the role of the property sector in driving growth, there's no replacement growth driving. And consumption is not going to pick up the slack. So what you're dealing with is much lower levels of growth. In order to get the number enough for it to be politically powerful, you got to stimulate a little bit, but you're not stimulating like you used to in a big stimulus sense. The numbers are going to be much lower.
So high unemployment in a place like the United States, so democracy is a threat to the political future of the individual in the White House. In China, it's an existential threat to the Communist Party, the whole regime, the system. What kind of levels of unemployment, what does the rest of the economy look like as you transition from 5, 4, 3, 2, and maybe, as you say, that's 4% GDP growth?
Demographics are enormous headwind for China, but in the short term, they're very salutary because you have fewer people in the workforce, you have fewer people, fewer population, you're going to have less of a problem with employment. It's just going to help use the trend. So in the short term, the fact that China has all these working population headwinds, it's going to help the transition if they do it right. But it means the long-term picture is going to be extremely challenging.
What is the fiscal space? If somebody walks in behind those red doors into the leadership offices and say, I'm modeling to 3% national Chinese GDP, in America, somebody goes, fiscal space, let's try to get to work. Do they have fiscal space? Do they have a normal mechanism of stimulus if they need it?
They do, but they're very concerned about it. If you look at the last 3, 4, even 5 years, there's been much less reliance on stimulating the business. A lot of people, you look at the PMI, you look at GDP growth data, and everyone's talking about growth. How much is China growing? But the best lens in China is always credit. And we saw in the first quarter was the rate of the biggest single one-off drop in credit costs that we've seen in the history of China based over a decade of data. Rates just dropped to the floor. And they dropped where? Retail, services, private firms, SMEs, all the places that China really wants to get close to. So we have been very cautious about saying that the government's providing policy support to the economy for several years now. There is policy support for the economy right now. One reason we're much more bullish on the future.
We always suggest that China has control, that it's best of them, and they can just pull different levers and ultimately end up where they want to end up. Any sign that they've lost control of the direction of this economy?
No, I think they are maintaining control of the direction of the economy, but this depends on understanding where the economy is going. The old growth levels, anywhere near the old growth level, are no longer possible. They could be possible in the short term in order to reduce growth, but they have long-term consequences. They're going to much slower growth going forward. And non-commercial financial system in China is to head up those holes and make sure that the ship doesn't sink. Yeah. It means that you're dealing with much slower growth over time as you're chasing out the levels.
Tom asked the right question. What do you look to? Tom talked about electricity in one particular city, and you mentioned credit. Where can you get reliable data on what is actually happening in the economy? Which is why we used to look at electricity usage back in the day, because people didn't believe you could trust the GDP figures. You mentioned credit. Where do you find reliable information?
Well, look, I mean, there's not that many good sources of data right now. And China based but the problem here is that there are these macro indicators that are used as proxies of the economy. Right. Beijing gets it, and then they start manipulating that data.
Very quickly, this economy is blue and black. She changed the dialogue of China. She's always said Xi is weak domestically,
Well, he's undergoing a right now. It doesn't mean that Xi is weak to the point where he's going to lose control, but it does mean that when you're associated with where the economy is going, with where China's going, with China's international image so much, it means you have many more challenges at just being a legal country. We now represent China on the international stage.
We talked a lot about Macron's visit every weekend. What was your response to that? Your reaction?
It's the French being French. I don't think that there are many people right now that what a beautiful strategic stroke this was for Macron to do it. You know, there's just a change back to the idea that, hey, you want to try to rate the France important too? No, I think you're going to be a national stage.
I'm ready to go back and see this on TV. Don't do this. We don't want Miller. It's the French being French. We just don't want to see that.
Later, thank you.
We'll never get into the French to see that.
International. Your thoughts on that?
It's just brilliant. And this is the guessing. This is only advanced surveillance, John. This is what we want. It's really knowledgeable people, always opinionated, always differing in opinion. And on China, and you talk about the code word for Gordieva, a fragmentation.
Yeah.
The fragmentation between China and America is tangible.
The conversations continue down here in Washington, D.C. I'm sure in about 10 minutes from now, we'll catch up with Alicia Lee, the online manager, wealth management, the MBA from S&P 500. Just about negative, just Washington.
From the Fed's perspective, from a macroeconomic perspective, there simply is still a very clear indication that the labor market is tight.
There's some mixed parts of the data, but if the Fed wants to go, they've got the excuse to go 25 years.
It feels like we have one more hike in the COGS for the main meeting that Fed keeps policy stable for the remainder of the year.
We've never seen this much tightening without a recession. It's going to be maybe a deeper recession than people give it credit for.
This is Bloomberg Surveillance with Tom Key, Jonathan Farrell, and Lisa Abramowitz.
With you from the nation's capital, through the league, live from Washington, D.C. this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom King. I'm Jonathan Farrell. Your equity market futures did turn negative in the last 45 minutes or so.
Longest of the week. I think this week, today's rather more general. Tomorrow, even if the IMF and the World Bank, they will parse United States inflation. It's that important on an international basis. And then with a vengeance, we really get going after the World Economic Outlook presentation. I believe tomorrow, Thursday and Friday, they have much more to do with shocking, not gloom, but just the caution that IMF has about the cash flow. Not only was it here, but it did memorable. I believe it was a Swiss franc that was challenged a while back. Yeah, that's sort of unspoken here, but nevertheless, there's quite a piece of it.
12 months ago, we were talking about hiking into high inflation. Central banks around the world needing to do more. 12 months ago, we were running the risk of hiking into a crisis, whether it's the ECB and the Federal Reserve after doing a lot in a very small amount of time, a very small window, 12 months, zero, to both the 4% approaching 5. John Williams of the New York talked about this at the NYU, New York University overnight. John Williams mentioned that he does not think the banking fallout of the last month is in any way, shape, or form connected to the speed and the rapidity in which they raised interest rates in the last 12.
I don't know about anyone. Here we have it on radio. I personally don't think it was a case of the pace of rate increases was really behind the issues. And two banks back in March, I think it's well understood there were some pretty idiosyncratic specific issues with those institutions. The distinction here is Olivier Blanchard would say maybe it's not narrow and idiosyncratic, but there's other larger issues going on than just worrying about the ISLM function and fixing economics.
So they've still got to deal with the consequences. And we need to think about the ripple effect of the shock of the last month, Tom. Some, and we mentioned this earlier, including Citi, Veronica Clark, Andrew Converse, making the point that they believe that any spillover is likely to be contained and limited. Others think the credit crunch has started. Now, when you come out on that, it's going to shape your view on how far you think the Federal Reserve can go. If you're in the former camp, Citi, you think rates can go to 550, 575. If
you're the latter, credit crunch, Apollo, others, you think perhaps the last time of this cycle has already been delivered? That's why we see such a spread on the streets.
I would think that politically they'll move away from financial analysis. Yes, they'll look at any bank crisis that we have. Look at that. And far more than just a pure GDP analysis of 3% moving under 2%. And if you get under a 1% US GDP dialogue, either present or guesstimates into the future, that's when you really get a change in dialogue.
Joining us now to talk about some of the clean the head investment strategy, equity solutions to BNY Wealth Management. Alicia, wonderful to chat with you. We miss you, and we wish we were here down in DC with us. She's up in New York this morning. Alicia, I want to start with a line from Bank of America and Michael Harner. Michael Harner put out a note, and he said investors are too optimistic on rate cuts and not enough on recession. Do you agree with it?
So the equity market right now is in that betwixt and between place of incorporating both the chance of a mild recession and a soft landing. Because if you think about where the earnings spread could be in either of these scenarios this year, you know, on the recession side, you're down to about $190 a share for S&P earnings, and in the soft landing, you're at about $230. And right now, the market is trading kind of at that midway point, could go either way. So the market is agnostic right now on the recession, and I do think the market is clearly not pricing in a recession, but neither is it pricing in a soft landing. It's pricing in a wait and see what happens. Unlike the bond market, of course, which is pricing in a pretty notable recession. The 2s10s, the 3-month 10-year, it's all shouting recession. So the equity market's not pricing it at all. And the thought that the Fed's going to cut 3 times by the end of the year, which is what the pricing of the curve is, presupposes a pretty notable slowdown that the Fed is forced to cut.
Alicia, it was before your time, but you have the courage to go back in history and look at the world according to GARP. What is GARP, and how do you drag it out of the ancient past into present choice of what to do in the equity markets?
Right. So, you know, as advisors and as investors, you know, we don't have the choice of avoiding the equity market. We go right into this. And GARP is growth at a reasonable price. And what that means is we don't want to be sector specific, but we do want to be in companies that have growth rates on the revenue line and can maintain their margins and therefore bring earnings to the bottom line. And you can find those companies throughout all 11 sectors. And that's how we are focused our investment theme right now, because, you know, the risk of being out of the market is that you miss the rallies, which ultimately grow out of this. In the end, nobody has a crystal ball. And while it looks like we're headed towards a recession, if we're not to be in the equity market would be a mistake.
But Alicia, Adam too was with us yesterday at Columbia. He made real clear nominal GDP isn't just analysis. Do we get a sprightly nominal GDP that colors or deceives that GARP strategy?
It doesn't, because nominal GDP feeds right into earnings. And so in the end, we don't talk about real earnings. We don't talk about earnings separate from inflation. We talk about nominal earnings, and this is how the market is priced, which is why it's not always the case that inflation is bad for the equity market, because it does get filtered through earnings, which are nominal. So GARP does not take that away. The issue is the margins. In the end, less focused on the revenue line, which will be flattered by inflation, and on the cost line and the margins, whether or not the costs are coming lower as inflation moves lower. If that happens, then you're set up for an equity market that can really rally into the half of the year. So it's all about what happens during earnings season and the margin line.
Let's talk about earnings. You know the arc of earnings season. The banks go first, Alicia. We'll hear from JP Morgan later this week. What are you expecting to hear from some of these major players in the financial sector?
Look, the big question is going to be on the outlook, and the question is going to be on funding going forward and the impact of any kind of regulation. I think in the end, the large banks and even the medium-sized banks have weathered the first quarter very well. Higher rates did flatter some of the earnings there. The question is, you know, what does the new world look like when the FDIC and the Fed has guaranteed some deposits of the 2 banks that failed? What does that mean going forward on regulation, and how does that impact earnings? That's really the big question here. I think most investors, or at least analysts on Wall Street, have become experts on bank balance sheets at this point. It's a little bit of a joke, but true. And I think the issues are well known. So there's no secrets out there. It's not shrouded in mystery. The issue really is what happens with regulation going forward, which is an unknown.
Do you have to make the assumption now? Can you make a conclusion that it will be a less profitable world for these banks?
Well, I would expand that to the entire S&P, which is that earnings estimates have barely budged in the last 5 weeks since Silicon Valley Bank and Signature Bank failed. And I think that doesn't really pass the reality test here. So overall, earnings have to move lower. So it's in all the sectors, simply because the pressure of it is going to move lower. I think there are certain sectors, particularly in some of the cyclical sectors, that have really already had their bear market and the bringing down of earnings estimates quarter after quarter after quarter. And I think those actually, interestingly, are places to invest simply because they've already signaled either inventories were too high or they cut estimates so many quarters in a row that you're starting from a very different place. So I'd expand that for the S&P.
Talking about retailers, Alicia?
I'm not talking about retailers. Some of the semis, for instance, are really interesting because if you think about quarter after quarter, there's a reason they rallied. They rallied because they were down 50 to 70% last year on lower guidance and inventory gluts and slowdowns that were projected. Well, they've already had their bear market. They've already had their correction. And I think going forward, it's an interesting place.
Interesting. That's cool. Alicia, love catching up with you. You know that. Alicia Levine there of BNY Wealth Management out of New York. Here in Washington, D.C., just want to pick up on some economic data we had a little bit earlier this morning. A survey from NFIB. It's a small business survey, closely followed in the United States, Tom. And net 9% of owners who borrow frequently said financing was harder to get compared to 3 months earlier. That number, the most since December 2012, according to that survey from the National Federation of Independent Business, out a little bit earlier this morning.
This is the microdata. It's all coming out. It can be this, that, the other thing as well. And what's so important is this a trend or is this a one-off? And I don't see anybody guesstimating it's a one-off. It's a trend in place, and to wonder where that trend will be 3 NFIB studies from now.
And to what extent, to what degree is that a substitute for more rate hikes from the Federal Reserve? That's ultimately the call, right? That's ultimately the call.
Yeah, I strongly take that point, and I go to Dominic Constant was way out front, was super restrictive, and he and Jerome Powell, you and me and the rest, we did not guesstimate that we would have a super restriction from banking dynamics, and yet that's the surprise we've had.
So I usually step away from the studio in about 20 minutes time to prepare for the next program, Tom. I have to say I'll be glued to the TV and the radio as well through the office, because coming up at about 8:45 Eastern time, so about 30 minutes from now, Tom Keene, one-on-one with John Bolter, the former National Security Advisor. TK, I'm looking forward to hearing you talk with John a little bit later.
Incredibly important interview and well-timed, with the silence in Washington over intelligence leakage.
From the nation's capital, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Pentagon says those leaked documents that detail U.S. spying on other countries is a risk to security. The papers include an assessment of weakness in Ukraine's military. The Pentagon is conducting damage assessment. Meanwhile, the Justice Department is trying to find out who leaked the documents. In North Korea, Kim Jong-un has called for what were described as practical and offensive war capabilities. That came as Pyongyang cut off communication links with South Korea used to reduce tensions on their border. This year, North Korea has tested new weapons and systems to deliver nuclear strikes against the U.S., South Korea, and Japan. In England, the state-run health service is bracing for its most disruptive strike yet. Tens of thousands of junior doctors walked off the job today for 96 hours. They're joining other public sector workers who are demanding bigger pay hikes to make up for inflation. The founder of blood testing startup Theranos has been ordered to report to prison this month as scheduled. A judge in California rejected Elizabeth Holmes' request to remain free on bail while she appeals her fraud conviction. Holmes was sentenced to more than 11 years in prison for deceiving investors. And billionaires Tyler and Cameron Winklevoss are using their own money to support their crypto exchange, Gemini Trust. Bloomberg's learned the twins have made a $100 million loan to Gemini. The firm has faced numerous setbacks during the year-long market downturn for digital assets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
When you think about the dynamics over the last 6 to 12 months, complete shift in psychology, inflation still stubborn in a lot of countries. I think that's going to keep rates pretty well above pre-pandemic levels for a long time. So back to 2019 levels, not anytime soon, many, many years.
That's the call from Mike Schumacher, the global head of macro strategy at Wells Fargo, pushing back against the IMF view that once we've dealt with inflation, rates can go back to pre-pandemic levels. That's going to be a key feature of the conversation down in Washington as we approach the IMF meetings a little bit this week on this program. I'm happy to say that Lisa's going to return tomorrow before to catch up with Graham. I can tell you now she's been working tremendously hard on this. She will be launching a surveillance newsletter a little bit later on this morning. You can sign up at bloomberg.com/newsletters. That's bloomberg.com/newsletters. Graham's daily musings on Bloomberg Surveillance.
We have 6 or 7 names on it. The working title 3 months ago was Toxic Group, right?
When the daily started, I like Toxic Group, that's nice.
Well, yeah, you got to pop on the internet and not on Twitter. You can see this out on Twitter. We're going to fly the hell out of it.
But I'm looking forward to it. It begins today, and this is going to be back on the program with us tomorrow morning. So we'll be covering the IMF meetings through the
Right now, on the bond report, Ian Williams, head of U.S. strategy, BMO Capital Markets. And Ian, I was getting a brief this morning from my senior executive qualified producer, Qantas, and Qantas said, Tom, you got to look at the BTMM Go screen on the Bloomberg. You look at it all day, Ian, what are you seeing in the 3 months and in April right now? What is the indication for 1 month, 2 months, 3 months, dare I say 6 month yield?
So right now, at the moment, Tom, what we see is that the most high-yielding aspect of the treasury market is in the very front of the curve. And what real rates are responding to are 2 things. First, we have a monetary policymaker in the form of a Fed who's willing to get us a terminal and full terminal for extended period. So that's going to impact the 3-month bill. That's going to impact the 6-month bill. But perhaps more importantly, there's a fair amount of uncertainty at the moment on the real rates to the debt ceiling and the potential for dislocations in certain bills if they fall into the window where the treasury market.
And I look at the 3 month as compared to 10-year yield, the 3 month, 10-year spread. And I'm not allowed to do standard deviation studies in Washington, if I'm American, but if I did, the inversion of that curve, that 20, 30 years, is 4, 5, 6, or I'd say 7 standard deviations, massively inverted. What does that signal?
Well, historically, the Fed has looked at the 3-month bill versus 10-year curve as an indication of the probability of a recession within the next 12 months. So at the moment, it suggests that we are at a high probability of a recession in the year ahead. What I think is more fascinating is that market participants are very interested in looking to extract the severity of the inversion and map that against how large a recession we might or might not see. I think that's going to create uncertainty, if for no other reason, because embedded within this is the idea that the Fed is going to be effective in containing inflation expectations going forward, and that should compress break-evens. I think that's one of the key reasons the curve is so inverted.
When the curve is inverted like this, particularly at the front end of the way you describe, does that impede maturity transformation? And perhaps I put that in a more simple way, does that prevent banks from lending to the economy in the way they traditionally would?
I think that in a traditional environment, a steep yield curve is the best case scenario for banks because they can borrow at comparatively low rates and lend at higher rates. Fast forward to today, however, we're in a unique environment where financial assets more broadly are responding to a drop in rates. So as we can see, risk assets do well, stocks in particular, when either realized yields decline or conditions for policy rates shift forward. So we're in an environment where the traditional might not necessarily hold. We are in the mode of bad news being good for risk assets, which really does complicate the Fed's outlook for the next several months.
So if we take the whole curve, as Tom pointed out, from T-bills all the way out to, say, the 10-year, let's cut off bills and just look at, say, the 2-year note out. What we've seen there is a bull steepener. The re-steepening of the curve, taking away some of that inversion over the last month, and that's because we're practicing a lot of rate cuts, and you alluded to that. Ian, I just wonder in your mind whether that move has gone a little bit too far, too quickly, based on what we're expecting the Federal Reserve later this year.
I think that the outcome between now and the end of the year is particularly binary. And by that, I mean we're either going to end the year with effective Fed funds at 5.1%, as the Fed has already suggested via the S&P, or things are going to go bad enough that the Fed is going to need to cut 150 or 200 basis points to offset any slowdown increase in the economy.
Ian, there's such respect for the persistency, the quality of your work. I want you to speak to the younger Turks of fixed income who are getting used to an environment we knew decades ago. What is the number one pro tip you have for people who went from negative real yields, negative rates, out to where we were, harkening back to another time? What's your number one pro tip?
That's a great question, and I appreciate the kind words. I would say if I could impart one piece of wisdom, it would be that U.S. rates are impossible to model in the traditional way because what impacts the overall risk-free rate is constantly changing, whether it ends up being a traditional impact such as inflation or geopolitical concerns or political concerns in Washington as it relates to debt ceiling. The primary influence is always moving, and so stay connected with what's going on and make sure that you're dynamic in your thinking about how to pick rates going forward.
In what you said 60 seconds ago was amazing, but this is binary. But this is basically going to mean the Fed is at 5.1 year end, or they have to cut between 100 to 150 basis points. Neil Duff of Renmac said the same thing the last couple of years. He said there's no in between the banking crisis. Either they're not going to cut, or you haven't priced in enough cuts at all, even with this move that we priced over the last month. Now, Ian, when you say that to clients, that must drive them nuts. You can say on the one hand, we might end up 5, on the other hand, we might end up 150 basis points lower. Ian, what do they say back to you?
One of the key aspects of our outlook for this year is we do see, regardless of what the Fed ends up doing, that 10-year yields in the year at 3%. So one of two things occurs. One is things go bad enough in the real economy that the Fed is forced to cut and cut more dramatically, or the Fed is successful in reestablishing price stability, which further compresses break-evens. And all else being equal, for the same real rate, if break-evens are declining, you can easily get nominal 10-year yields to trade with a two-handle. And that message has been remarkably well received.
Wow, Ian, that's amazing. That is quite cool. Ian in there at BMO Capital Markets, Ian out of New York. What cool. So basically it goes bad and they have to cut, and the 10-year goes to 3, maybe a two-handle, or it goes well and they get the disinflationary trends they want, and the 10-year still has to go down to 3, maybe a 2.
John, is what I had before. If you're not part of global Wall Street, bottle that. You just heard from a guy, his wisdom for those young people, the primary thing you were talking about, John, and he sums it up with a 2 major HSBC yield outcome that no one on the planet believes except Kristalina Georgieva.
I try and put Michael JP Morgan Asset Management too. He thinks 3.00 on a 10-year. And what 40 basis points about a yield at the moment.
I take your point of 40 basis points or even to get to a shocking 295, but people aren't modeling it. They're modeling out a toxic world. Right down, yield up. This could be in the newsletter today.
I imagine it will be. Next hour on Bloomberg TV, Matt Morgan Stanley, Henry Rowland of JH Investments, Tony Rodriguez, and Ruby. That's this conversation forward. This is Bloomberg.
Bloomberg Surveillance. Good morning, everyone. On radio and television from our studios in Washington. Tom Kane, as we begin 4 days of coverage. International economics, yeah, still focusing on the markets. That inflation report tomorrow. What I want to say about the data is real simple. There's a churn to the market. We had green on the screen earlier, ebbed away a little bit, and we come back ever so slightly. Maybe possibly equities, bonds, currencies, and indeed commodities waiting for that inflation report tomorrow. I would note American oil, West Texas Intermediate, under $80 a barrel. What a joy yesterday to greet Adam Tooze, of course, adding so much to this discussion of economics. And all of it, including my panel on Friday with Gita Gopinath, center around the outlook for what an appropriate growth rate is. We advance that conversation now with Michael Darda, Chief Economist and Market Strategist Roth, MK & Partners. Michael, it's such a rich discussion right now, and the polarity of this around R-star, and I want to stay away from the arcane, is the guesstimate of an appropriate run rate for an economy of higher or lower post-pandemic. You side in that we will see subdued R-star and a surprisingly slower overall economy. How do we get there?
Well, Tom, I think you could just ask the question whether
the underlying fundamental drivers of the supply side of the economy have picked up dramatically. And if we look at the trends in non-farm productivity, it really doesn't look like there's been much of a pickup. In fact, the numbers are actually quite a bit weaker than the average of the last business cycle. And we know that in terms of working age population growth and demographics, those things don't just change on a dime. So it doesn't look like there's some kind of big structural shift. What defines this business cycle and differentiates it from the last is the explosive average growth rate of nominal spending in the double digits on average. But we think that is going to come to an end in very short order. Now that the Fed has tightened policy so abruptly, and we have this backdrop of a contraction in money and credit. So looking forward, these nominal GDP figures, I think, are going to end up sinking below the average of the trend of the last business cycle. And with that, inflation will come down a lot as well.
Well, let's somebody get the market call out of the way. What does the 10-year yield do in that environment? We've heard from a number of people today shocking us with a 3.0 or even a 2% handle on the 10-year yield. Do you suggest we fall below 3%?
I think we could, Tom. In fact, I think it was on this show last September where we came out and announced a bullish view across the Treasury curve. So that turned out to be a little bit early, but the call is working. I think, by the end of the year, 2 3/4, 3% on the 10-year is very much doable. But that's in the context of the U.S. economy likely falling into a recession. And with recession, you get lower inflation, a lower equilibrium interest rate, and Fed rate cuts.
One of your great mentors was Jude Wanniski, the late great Jude Wanniski, and he had the courage to have a vision out 60 months. So does the International Monetary Fund. And they shocked us a number of days ago in conversation with Dr. Georgieva of a shocking 5-year 3% global GDP. Does America participate in that, or could there be American exceptionalism where we do better?
Well, Tom, we could do better if productivity growth picks up. But as we just discussed, not a lot of evidence of that at the moment. Perhaps some things could be done on the supply side to try to boost innovation and efficiency. But it's really hard to see a dramatic shift afoot. Perhaps some innovation comes along that that really boosts the capacity side economy. But I think the numbers that we were seeing in the last business cycle are probably fairly close to what we would look for in a steady state equilibrium. If productivity growth is 1.5 or so, labor force growth is going to be 0.5 percentage point, so 2% real, and then with the 2% inflation target over time, nominal growth around 4%. I think that's the most reasonable. We could talk about outliers and upside or downside surprises, but in terms of a base case scenario, I think that's what we're looking at. And so the current rate levels I think make sense in that context. Although in a recession scenario, you end up going lower. And I think, unfortunately, that's probably where we're headed.
Within the continuum of 4, 5, 6, even 7 front-rate economists, leading people who frame out from a 2% Fed guidance out much, much higher, I want to focus on the former Vice Chairman of the Federal Reserve System, Richard Clarida of Columbia, who in The Economist this week, Michael, laid out as a former Fed official an ability to get back to above 2%. Institutionally, how does the Fed react to Clarida above 2% trend rate on yield and on policy?
Look, Tom, if it's coming from the supply side, if it's coming from efficiency gains, productivity gains, then that's completely consistent with the Fed hitting its inflation target over time. In fact, a positive supply side shock will lift real magnitudes, real growth rates, and lower inflation rates, all of the things equal. Okay, so if that's what we're talking about, that's completely consistent with the Fed's goals. If we're talking about demand side stimulus, that's a different story. That's that's under the Fed's control, and they have to bring nominal spending down in order to control inflation and get back to target. So I think if we're going to get a faster trend growth rate because of enhanced efficiency, then yeah, for sure, that's the gift that keeps on giving. We'll see if we can do that.
Frame 12 months forward, nominal GDP and real GDP. I think our market economist crew would like to know what you think on that. Where is nominal 12 months out year over year and also inflation adjusted?
Tom, I think we're going to tumble pretty hard moving into mid-year and in late 2023. So if we look at some of the leading barometers of nominal spending, I mentioned before that we have a contraction in the banking system. So in just 2 weeks, we saw commercial bank credit collapse by more than $300 billion. Commercial bank deposits are down close to $1 trillion over the course of just over a year. And you've got the Fed that has its policy rate above every note and bond yield across the Treasury yield curve. So that is not a configuration that should lead us into thinking that there's going to be some kind of perfect soft landing or no landing scenario. I think the landing could be quite a bit harder than many are discussing. And in that context, you could have nominal GDP fall to 0, even below 0 temporarily. And that is a recession scenario. It won't be a permanent state of affairs. Eventually, the Fed will have to adjust. But I'm afraid they're being dragged along by lagging indicators of the business cycle. Service sector inflation is in the index of lagging economic indicators. Payroll growth is critical, but it's a coincident indicator. The forward-looking data is pointing down at the moment. And we just got the NFIB data for March. If you look at the underlying index on small business credit conditions, availability of loans, we're at levels now that you do not see outside of recessions.
Right. John, what's so important here? John Farrell mentioning NFIB earlier. Michael Darda, let's go to University of Wisconsin textbooks, which tell me, given the Darda scenario, you're going to get stabilizers to come in. Do we have the fiscal space, and other attributes that can stabilize the economy, given your cautious view?
I don't think there's any scope whatsoever for demand side fiscal stimulus. That makes absolutely no sense when the Fed has policy rates up close to 5%. So there's tremendous scope for the Fed to reduce the policy rate if that is appropriate and that is required. And obviously, there are other things the Fed can do to ease monetary policy and to boost aggregate demand when the time comes. They still want to be sure that inflation